Good morning. It's Friday and it's time for the closing bell. Let's ring it in. You got Salt and Pepper here with you coming live.
Spice of life, salt and pepper. There we go.
A little sweet, a little savory, a little spicy, right? That's
A
we got
little
to keep
spice.
it. And hopefully you guys find this entertaining, but it's super fun to be here with you. We got some good topics to cover today, right, Mark?
Yeah, I'm excited. Yeah, a lot of things happening. A lot of yeah, I mean, really historic events going on, and just with interest rates and deficits, all this stuff. We'll talk about it here. Let's get rolling.
Absolutely. All right, let's dive into it here. So, before we get into the global markets in review here, I want to touch on a more optimistic topic within the markets because there's been a lot of uncertainty, which you're going to kind of get into how bad of a third quarter we had. But first, before we do that, really want to be optimistic in terms of long-term view. So bull markets have dominated bear markets. Remember, bull markets are over 20% increases in the market. Bear markets are pullbacks of at least 20%. It's also bulls are optimists, bears tend to be pessimists. So there's multiple ways we can look at it. But if we're looking at the history of the markets, bulls have dominated the bear markets, 67-12 actually. So it might sound lopsided, but let's highlight a few important key facts when looking at bulls and bear markets. So since 1950, again, 67-12, the average gain during a bull market is 265% compared to a 33% decline for the average bear market. And bear markets tend to average around 12 months, while bull markets, last 6 times longer. So again, a lot more bull markets, a lot more duration in bull markets than bear markets, even though it's hard to remember that when times get bad or when times
Right?
get tough.
No doubt about it. That's really tough. It's tough to remember those things, but overall, year over year, over long term, like you said, bull
Mm-hmm.
markets crush bear markets.
Mm-hmm.
And that's always very encouraging. Hey, by the way, do you know where the bulls and bears come from, Jason? You know that? Do you know where they get that? Where that started?
Was it the 1920s? When was
It was
it?
way back, yeah, right, yeah, when I was a teenager. So it was like, no, but it bulls. So the idea of bulls and bears fighting, right? So if a bear comes, the idea is this is legend, but if a bear and a bull were fighting, a bear would grab a bull and pull it down, right?
Mm.
So bear down, right? Taking
Oh,
them down, taking the bull down. Whereas a bull, the way they fight, in the bullfighting is when they attack, and then what do? They stick their horns in and go where?
uh,
Up. All
oh,
right. So
interesting.
bears down, bulls up. Little little
Oh,
little trivia that you can use on.
that's really good.
Anyway, just FYI.
And for everyone listening, that's going to be a trivia question. You can win a prize from us later this year, a Christmas gift. But that's really good. That's actually really, really good. I like
Yeah,
that.
that's a little salt, a little spice. You didn't know that. That's the advantage of being old and salty. But anyway, yeah. But to your point, yeah, that's actually really encouraging, and it's important for us to remember that long term view. That's really important, especially there's a lot of negative news out there, and I told my wife like we're going to stop watching the news because it's
Yeah.
like it's discouraging. But yet we got to we're very optimistic and want to stay that way. There's a lot of good things happening, and the truth is
Yeah.
that's history. We don't know. Nobody knows what tomorrow brings. But so our best view is looking back and seeing how history has responded. And
Hmm.
so when we do that, you come up with the stats you're talking about. That's really encouraging. So
Yep.
yeah, stick
And,
with it. That's what we're banking on.
and things to remember, right? Like recoveries in markets are rarely straight up. It's rarely a smooth ride.
Yeah.
There's unsettling headlines, like you kind of mentioned, like sometimes you just got to not watch the news because they want clicks, right? Significant market
Yeah.
volatility and additional equity declines are always on the table. But again, having that long view, like you just mentioned,
Yeah, but let's look at
is
today, right? So even today, when you look at the markets, like I wake up, I get up early. I always look at, before the market opens here. It's 6:30
Mhm.
a.m. So you get a jobs report that hits like 5:45 in the morning our time, and it's like robust. And we're going to talk about that in a second. So bad news, inflation, economy's still going, and the market opens up negative almost 300 points on the Dow. It's like, holy
Yeah.
smokes, right?
Yep.
And then, if you panic at that point, go, oh, gosh, we're headed to, we're going down,
Yep.
within a couple hours, the market's up almost 300 points. I mean, it's volatility right now, and you just never know. So the emotion can get you in big trouble if you react on emotion.
Absolutely, and as you can see today, the Dow is trying to fight back to
Yeah.
neutral territory. It's down a little bit. S&P, Nasdaq both up. Nasdaq's obviously leading the pack over 1.4% gain this last 5 days. Russell's trailing, obviously higher rates. That's kind of the heartbeat of the small business, almost down 2.5%. But why don't you kind of get into why the third quarter was so difficult and kind of bird's eye view of that?
Yeah, I mean, I think it goes back to we had a big run early on, and this year has been a narrow run. Only they talk about the fabulous, miraculous seven or whatever it is, where there's just some of the key tech stocks that are really rocking.
Yep.
It's been a narrow advance, but yet still an advance. Nasdaq, S&P, all those up. S&P in the third quarter actually gave back some of the gains, about 3.3% in the third quarter. And so far in September, slid almost, to almost another 5%. So it's kind of, again, we were talking about October is usually, last week we talked about how, October has a bad rap as you enter in. Everybody
Yeah.
remembers, the late 80s and different times in October when the markets have just tanked. So you usually get it's not unusual to have a bad October or, September, October. And then, the other thing is, if you look on the positive side, October has been known as a bear killer, right? To
Yep.
actually, this is a time going into the year end that we actually get a rally. So, maybe that's happening today, maybe not, but it's been a pullback, not unexpected. We've been talking about that for a while. What's interesting is, even energy started this year has been one of the bright spots, especially the last few years as we've gotten the pullback.
Yep.
Energy's, been an area where it's been, really, really solid. And yet, even in this pullback, energy's been getting hit a little bit, in the last week or so. So,
Yeah.
again, it's hard to figure out what's going on and all that, but it's the reality is that everything's going up and down, and we're looking for a positive going into the year end. That's what history has shown, and it looks like and I don't know, it'll be interesting, but I got a feeling we'll probably see that.
Good insight there. And yeah, like you said, energy skyrocketed. It was far and away the top performing sector in the third quarter, more than 11% price gain. Communication services, tech also had a good quarter. Alphabet, Meta finished second, 2.8% in advance with that communication services sector. Utilities got hammered, obviously with higher yields and bonds. Investors who would traditionally go for the higher dividend in those utility stocks have actually kind of gone to a less risky asset, gone to the bond side to get that same yield, sometimes same dividend yield, right? So,
Yeah.
like you said, it's kind of interesting. Oil prices have come down almost, $8 a barrel approximately at time of recording here. So that's going to obviously take some wind out of the sails for the energy sector. But some good points that you made up. So why don't we talk about what's going on in the government? Right? It's been an interesting 2 weeks now. They averted a government shutdown, which was good. They funded a short term kind of spending bill through November, which they tend to do quite a bit. Just again, trying to prolong the inevitable of, hey, we're gonna have to reach a deal at some point. So Kevin McCarthy, House Speaker, was kind of booted this week. Looks like Jim Jordan is getting a lot of support, which obviously we're big fans of. He's done a great job overall, and he's very well liked, I think. So, but what I'm trying to show with these charts here, and I think you could speak to this, you've seen a lot of different administrations, Republican, Democrat, and how the government has become so not
Large.
obsolete, but yeah, they've been spending up the wazoo. Let's just put it that way.
Yeah.
As you can see in the charts, net interest on federal debt as share of GDP is starting to skyrocket. That's the forecast because of higher interest rates that the Fed has instituted, the short-term borrowing rates. And then look at the budget deficit is expected to expand as well as part of GDP. So Well, in your professional opinion, again, this isn't about politics. This is more about, hey, government, it needs to be fiscally responsible. We've talked about.
So,
What have you seen in your past, and where do you see this going?
well, I mean, so you look at that net interest on the federal debt there, right? So, I mean, I think that spike there has to do a lot with the forecasted interest rates going forward.
Hmm.
Again, for the last 10 years or so, we've had really low rates, predominantly, and now that rates are back to, more long-term levels. And that's what kind of where we're at. I know there's a screen that we have that shows kind of where we're showing that, kind of coming back up there. So that interest rate, as anybody knows, when you're borrowing money, is that the interest payments, as interest rates go up, your interest payments go up. So
Hmm.
that's it gets more costly. And so,
Yep.
we're going back to a time when interest rates were, when you have a lower deficit, it's all relative in how large the deficit is. And so now when you're borrowing way more money than even back to the 70s and 80s, when you have higher interest rates, now the interest part of that payment gets really, really significant. And that's why you have that sharp increase there as forecast, is because, especially that's one of the things that is really hurting as interest rates continue to go up, is the cost of debt for the U.S. government. So we need fiscal responsibility in our leadership, no question about it. You cannot, nobody can. I mean, households across the board, we're all struggling now with interest rates being higher, the price of homes.
Yep.
It's more expensive to buy a house. It's more
Hmm.
expensive to, buy a refrigerator, put it
Yep.
on your card. I mean, all these interest rates are higher. And so that's what slows down the economy. So we need fiscal discipline, and we need our leaders to exercise it. And we need accountability across the board on what we're spending money on. And
Amen.
we need people in there that are actually going to hold people accountable. And so,
Yep.
all the things that are going on, I hope eventually it leads to that scenario, because it's really important for us as what the world leader to get our
Yep.
fiscal house in order and under control. So that'll be, that'll say a lot, and that's what hopefully we'll get that as we move forward.
And we mentioned this a few months ago now. Just you mentioned debt that's coming due. Obviously, we have to satisfy our previous debt obligations. So that's why in this top left chart, speaking to what you're talking about here, just want to reinforce that for people listening or
Yeah.
watching, is it looks like it's ballooning here. Um, for the next 30 years, approximately 27 years. That's because think about the 10-year treasuries, 20-year, 30-year treasuries that are being issued and that are going to be coming due at that point are pushing 4 or 5%. So obviously the government's going to have to satisfy those debt obligations at that point. So hey, we need near-term and long-term fiscal responsibility, so that way we're not continually issuing debt, more and more debt down the road, and going into $100 trillion of debt, which I could see in my lifetime. But again, while I'm still in the workforce 20, 30 years down the road, when you're retired, sitting on a beach with your wife, playing a guitar, uh
Wow, that's good. I
we're going
didn't
to
know
be
you.
on the hook for that. So that's all I'm just trying to reinforce. You hit it on the head there, but
Yeah.
that's what fiscal responsibility will bring, is we don't have to issue more debt. We can just utilize American growth, ingenuity, innovation, and
So look,
GDP.
again, I mean, you couldn't live like this. I can't live
No.
like this in my house budget. I mean, you just
Nope.
can't live like that. So why can our government live like this? Well,
Yeah.
one thing is that they can print money, and
Yep.
that's, again, that's so, if you could live like that and print your own money, and, had a, but, that would be fantastic, right? I mean, we all
Yeah.
want that ability. At some point, though, you have to pay the piper. And right now, that's what's happening, is you're trying to actually reduce the money supply in
Yep.
order to, quantitative tightening, and at the
Hmm.
same time raise rates to try to slow this economy down. It's an interesting place. And so you have, interest rates going up. You have a stronger dollar, now, because, other countries want to invest in the U.S. because they're getting better returns here, which also increases they have to delineate that into dollars, which increases that value, which this next graph here shows, talking about Japan. But also, I just wanted to make a point in regards to international investing.
Yep.
It's a it's a headwind to investing international when the dollar continues to go up. I think longer term here, it's got an incredible opportunity right now to invest with the dollar this high. I think it's a great opportunity to invest international, but I've been saying that for a while.
Yeah.
But I think I'm going to hold to it. Same with bonds. I think as interest rates have gone up, it's really been a headwind to the price of fixed income.
Yep.
But as investors, you have to remember that that's the case. And then, but at some point, there's a window here of opportunity. We talked about it last week. Is that longer duration bonds are going to really have a great impact, because not only will you get higher interest on the fixed income, but you also get principal. You actually get principal appreciation as interest rates eventually will come down in here after a pause.
Mm-hmm. Good points. So
Yeah.
you mentioned currency, foreign exchange. So I just want to touch on this really briefly. Again, we don't have to get in a long conversation, but talk about international investing. And Japan is one of those places that are really exciting, if not the most exciting place in the developed world right now, just because their government is instituting a more capitalist system that it favors shareholders, companies, lower taxes, shareholder friendly policies that would spurn growth in their economy. And so if you look at their topics index, which is kind of looking at S&P versus topics here, it's actually performed out of all the developed indexes in the world, performed the best, over 20% since late March. So quite a bit of an upside. But going back to your currency, conversion with a stronger US dollar, which has kind of reared its head again, it's gotten stronger as of late. It's been strong. And the yen has kind of been hovering around that 150 mark in terms of conversion to the US dollar, which they're trying to hold that support level because that's very important for them. But when they're converting that at this point, they're not getting as much bang for their buck. So even though they've been the best in terms of just looking at local currency, when you adjust it for, converting it to US dollars, it's right on par with the S&P 500. So as you said, going forward, it could be an interesting investment opportunity for investors, not only because of the policies that are instituted over there, but because of the currency conversion. So great points. Really good points.
And I love this chart because it shows the value of Japan's made a lot of really free market decisions recently in order to, and so we got to look at that and use that as an example. It really works. But when you see this chart here, it's just talking about, again, and you see this other places too. Japan's one of the highlights, but you're also there's companies outside the U.S. that have really much lower PE ratios, which is a kind of it's a valuation. It's like when you have lower PEs, they're more valuable. And so you're finding that outside the U.S. in a lot of areas. So, it hasn't, again, looking out longer term, this hasn't panned out currently, but at some point it'll be significant. I think for having some allocations of your portfolio in international areas like Japan.
Yep, absolutely. All right, so last thing we want to touch on, the jobs report that came out this week. Lots of different reports, BLS, JOLTS, all of these things. People are like, oh my gosh, there's all these different jobs reports. Like, what are we looking at here? So total non-farm payroll change from a month earlier. That's kind of the big one that we look at here. The Fed looks at as well. 336,000 jobs added this past month in September. Now, gotta remember, so I think they were expecting around 270,000. We just absolutely blew through that. A lot of that could have been kind of hiring, again, kind of like the summer hangover per se. A lot of it was leisure and hospitality, government workers. A lot of the lower wage earner brackets was hired. So, I mean, you can speak to that, right? I mean, this could be inflationary, but it could not be, right?
Yeah, it's very possible. I think that's what the market's, like I said, even today and on the recording of this podcast, we're getting, swings of 500 points on the Dow, because I think that's the big decision, the big question mark. Is this inflationary? These numbers blew out expectations, first of all. So the market is surprised by it. But at the same time, as you contemplate it, is it really as inflationary as it looks? And if it's this high and it beats numbers by so much, my question is is this sort of the last hurrah on the is this the last like spike that we're going to see in the employment numbers as we go into, not only, I mean, right now we're getting into this time of year where there's a lot of hospitality. You got all major holidays coming up here at the end of the year, a lot of
Yep.
things. So the companies are getting ready for that, perhaps, and to get through the holiday seasons through December, and then maybe again, this recession, this whole thing has been such a. It's not like it's a surprise to any companies. Everybody's getting ready. They understand where the markets and where the economy has been and where it could be. So I
Yep.
think they're making those decisions. So yeah, big surprise, but I think you got to say if it's really inflationary or not. And so
And
that's what the
that'll
market's
to be seen, right?
yeah.
And that's the thing. We don't know what's going to happen short term. We look at data, but again, just having that long term view of the economy and saying, hey, these tough times won't last. Tough people will. And obviously, the American worker is very resilient at this point. Again, jobless claims super low. Companies are still hiring. So if we can see more of that kind of soften a little bit, then the Fed might, pause at the next meeting here in beginning of November. But there's a 30% chance the market's pricing at this point that there could be another rate hike here, especially with the strong labor market and strong, resilient economy that we've had. So it is to be seen, but we'll definitely keep you updated, right?
Yeah, and I think again, and I say this a lot because I think it's, I guess it's just a value that we hold here at Boyer Financial, but it just goes back to the point of when you're looking at your portfolio based on what your goals and objectives are. You have to invest. You have to look at your lump sum. If you've got X amount of dollars in savings and how you're trying to invest that, how much of it is short term, how much of it is midterm kind of money needs, and how much of it is long term.
Yep.
And this is a time, again, before getting emotional, whether ups or downs or whatever, it's just so critical to have your asset allocation set up to where you can handle all those different
Yep.
scenarios, no matter what happens.
Absolutely.
Um, to be able to always find, with an all-weather portfolio, to find something if you have money needs in the near term that's in an upcycle. So that's really important. Just want to go back to that and make sure, again, as we're working with clients, that's what we're emphasizing all the time. Very important.
Good points. Well, that's all we had for you for the closing bell this week. Salt and Pepper here, signing off until next Friday. Hope you all have a wonderful weekend.
God bless you all.